We're very pleased to be able to speak today with David Connor, the CEO of OCBC Bank in Singapore, a bank that has gone through a tremendous transformation from what used to be a state bank to a bank that is innovative in its own way, progressive, and perhaps from our perspective, one of the strongest banks in the Asia-Pacific region. Strongest because of the diversity of income based by geography, by business lines that it generates, and also the strength of its franchise in its domestic marketplace. Thank you very much for speaking to us today, David.
Pleasure to be here.
You became CEO of the bank in 2002. Tell us a little bit about your beginnings with the bank. What did you enter? What did you look at when you first entered the franchise?
Well, you kind of have to cast yourself back to perspective. I mean, it was only a few years after the Asian crisis that I joined.
Yeah.
Things had improved quite a bit, but then with the dot-com bubble bursting, there were other problems that occurred. So I arrived at OCBC, and some of the issues were fairly obvious. One, the bank was very high in terms of provisioning. Put it in perspective, and we were something like $500 million in 02 and 03 that we wrote off. Now, again, put it in perspective, today we're a much bigger bank. Last year we had provisioning of less than $500 million, right in the middle of the crisis. So it was big numbers for OCBC at the time. There were some issues clearly with the portfolio. But one of the reasons that I was attracted to OCBC was very strong brand name, a very solidly capitalized bank, a bank that had a healthy franchise, and a very good name.
You think so? Because one would argue that it would be overcapitalized. It does have a strong brand name and a franchise, and coming from the Citibank environment that you came from, the ability to change things, to move along and get things done. What was your perspective at the time that you started with OCBC in terms of what the challenges might have been for you?
Well, I had a conversation before joining with the man who was going to be my boss, Mr. Lee Seng-Wee, who was the chairman of the board at the time. Most of the conversation was about values, to be perfectly honest with you, and then what was expected of me. It was a fairly straightforward conversation. The board said, build us a world-class bank. And I said to the board, this is verbatim conversation almost, how do you define a world-class bank? And they said, you tell us. So I actually wrote down, what I called at the time the hallmarks of a world-class bank. Now, what does a world-class bank do for its customers? What does a world-class bank do for products, product development, innovation? What does a world-class bank do in terms of risk management, in terms of productivity and ongoing productivity improvements? And I'm a big quality guy, so that was a significant part of it. And then what does a world-class bank do for employees? Surveying employees and understanding whether or not they're satisfied and improving the situation.
You wanted to do that from the very beginning.
Well, I said this was if you want, this is what a world-class bank does, and then a world-class bank delivers returns for its shareholders. Okay, but it starts with customers, products, risk management, productivity, employees, and then shareholder returns. And the board said, well, that's great. We agree with your definition. Now go out and do it. And so we then worked in the next 6 months with our management team and myself. Worked on a strategic plan, which we wound up naming New Horizons. Turned out to be New Horizons 1. It was a 3-year strategic plan. But a significant part of that was a balanced business scorecard. And we decided that we'd run the business basically with those elements: balanced business scorecard, customers, products, risk management, productivity, employees. And so we started to build a framework for what the bank would stand for from that point on. The strategy is really quite simple. I mean, it's one half is what are we going to do to expand internationally, and the other half is how do we run the business by a balanced business scorecard. And it's intended to be simple, so it's easy to communicate It's easy for our employees, all of them, to understand. And in particular, when we set KPIs, they cascade right down through my direct reports along the lines of the Balanced Business Scorecard.
How would you describe your relationship with your key managers in those early years? What needed to be done to create an engagement process with your key managers?
Well, we had a series of offsites that were facilitated by a business school professor who's worked with us, frankly, ever since, because he knows us well and he understands us. But we didn't bring any consultants in. We with the series of discussions and exercises, we did Porter analysis, you do SWOT analysis, you do competitor analysis, right, this sort of thing. And frankly, actually one of the most interesting exercises was looking at the history of OCBC and what it stood for as there were and what OCBC did to respond to strategic changes in the marketplace over literally 50 years. And with those insights, we started to gel as a team. But I made it very clear from the very beginning that we were going to bring in a lot of changes. Because I think that while the base was there, strong capital, good name, reasonably healthy franchise, clearly the performance of the bank was subpar.
Yes.
And so we had to lift the performance.
Well, the performance of the bank was subpar on, well, maybe two fronts at least. One is the ROA, the asset composition that you had, and the other was the fact that you were fundamentally overcapitalized in a way. Did it bother you in the early years, or did you have a personal mission to sort of create productivity on the financials?
Well, yeah. Part of the Balanced Business Scorecard, as I said, was to reward shareholders, and it was fairly clear that given the relative slow growth or low growth rates in Singapore, that we did have excess capital. And so we made it a very clear policy and made it public that we would return excess capital to shareholders through share buybacks. And we announced an initial 500 million share buyback and executed that. Then we announced on a follow-on, a second 500 million share buyback and executed that. And then we got into a third, which we suspended a couple of years ago because obviously we were hitting the crisis. I think we did 260 million or so, something like that, right, of that third share buyback program. We also made it very, very clear. One of the issues with OCBC and the requirements from the Monetary Authority was that we had to deal with the non-core businesses that, yes, we had, the hotel, yes, business and various shareholdings and properties, and so I also made it very clear, and we agreed as a management team, and we announced that we were not going to offer big dividends from divesting in non-core assets. So we said we're going to divest of non-core and invest in core. So we tried to make it very, very clear to shareholders that this wasn't a cookie jar to raid and cash out. It was a cookie jar to convert from non-core to core financial services.
What was the time frame in which you had to do that?
Well, there were requirements that were relatively short term. They actually were suspended during the SARS period, yeah, 2003, if you recall. They were suspended, yes, and we got a year's grace. But meeting the Monetary Authority requirements wasn't a big problem. We've sold quite a bit more than as required by the Monetary Authority in the end. And again, we've invested more than, I think it's 3 times as much now in core financial services.